Welcome to Ekesha's Foreign Exchange Made Easy class. Today is 18th session. Last day I have started option trading. Today it will be continued. Before proceeding, I will show one mistake in the last class on initial margin problem. You see that in the problem, when that 8,750 will be added, and I have written 1,43,000 instead of 1,43,750. It will be 1,43,750, and the last balance will be 1,70,750. It will be tally with the initial margin account here, 1,70,750, which is refunded to the participant. Bank account debit to initial margin account. This is the mistake I have done last day. Now come today's topic. Difference between future and option. Similarity, both the contracts have buyer and seller. Both the contracts have a set price for the underlying asset, that is future price in future contract and strike price in option contract. Both the contracts have a settlement date, that is expiry date. Difference. In future contract, both parties have right as well as obligation to buy and or sell the underlying asset and therefore face a similar risk. In option, buyer has right but no obligation to buy the call option or sell in put option and faces only the risk of premium paid, that is limited risk. On the other hand, the seller has the obligation when the buyer exercises the option, therefore faces unlimited risk. At the same time, the option buyer may get opportunity to enjoy unlimited gain and the option seller can enjoy limited gain equal to the premium received. Difference OTC and exchange traded currency option. In option market, some selected scheduled bank act as market maker for the customer who are Indian resident allowed to buy the option, that is pay the premium, but are not allowed to receive the premium. The option are mainly exercised by the customer with an object to hedge their exposure in export or import business or any allied activities where foreign currency are involved in the transaction. There are strict guidelines related to the amount and tenor of the option, which will be less than or equal to the exposed amount of foreign currency and tenor of the underlying trade transaction. For example, an importer is liable to pay $1 million after 3 months from the date of contract to a USA exporter. Under this trade transaction, the importer can buy a call option of USD INR for a maximum amount of $1 million for a maximum period of 3 months. The importer has to submit underlying trade transaction as a proof to the bank before booking the contract. In exchange traded operation, there are strict guidelines regarding the amount and tenor related to the underlying foreign exchange transaction. It is restricted to buy open interest and total volume in terms of currency pairs. You know what is open interest. It is already discussed. OTC exchange traded option in other underlying asset. Options that are traded between the private parties in the over-the-counter market rather than exchange are known as over-the-counter OTC option. Unlike exchange traded option, there are no standardized strike price and expiry dates in the OTC option agreement. These are decided by the parties based on mutual agreement. The OTC option is settled exclusively by the buyer and seller. In exchange traded option, the strike price and expiration date are standardized, and the options are executed and settled through the clearing house. In OTC trading, some benefits enjoyed by the traders. For small business, the traders are allowed to trade without having to be listed in stock exchange, and corporate who are listed on stock exchange are also benefited from lower financial and administrative expenses. It can be used for hedging, trading for risk transfer. It can provide more flexibility because traders are not bound by some set of rules as in exchange traded option derivative. The significant disadvantage of OTC option over the exchange traded is the risk of counterparties' failure to honor the terms of and conditions of the deal due to no disclosure mandates for OTC option, which makes this type of option transaction less transparent. Exchange traded options are settled through clearing house, which gives them additional layer of security against payment defaults. Due to lack of regulations, OTC option agreements are more or less self-regulated. The term of the business can be tweaked and customized to suit the interest of the both parties. Now come moneyness of option. The buyer of call option would exercise his right to buy the underlying asset only if the spot price of the underlying asset is higher than strike price at the time of maturity of the contract. Here, the contract will result in a positive cash flow. So here the call buyer will buy at strike price and sell it at market price, which is higher than the strike price. So the cash flow will be positive. The mode of operation of long call is same as long future, except the clause of premium in long call. Now come in other case, when the strike price is higher than or equal to the underlying asset, then no cash flow yielded in the transaction for the buyer of the call option. Similarly, the buyer of put option would exercise his right to sell the underlying asset only if the spot price of the underlying asset is lower or less than the strike price at the maturity of the contract. Here, the contract will result in a positive cash flows. Here, the put buyer buy at the market price and sell it at strike price, which is higher than the spot price, and gain and cash flow will be positive. The mode of operation is same that as a short future except the premium in the long put. Moneyness of an option indicates that whether the contract would yield a positive cash flow, negative cash flow or zero cash flow, assuming zero transaction cost and zero option premium. Based on the scenarios, whether the contract would yield a positive cash flow, negative cash flow or zero cash flow, moneyness of the option can be classified in three types which is given below. Number 1, in the money, ITM option. An option is said in the money ITM if on exercising it, the option buyer gets a positive cash flow. In the case of long option buyer, he would be in the money situation, that is ITM, when the underlying price is higher than the strike price. The difference, spot minus strike price, if positive, is called intrinsic value for call option buyer in the money situation, that is ITM situation. In the case of put option buyer, he would be in the money situation when the underlying price is less than the strike price. This difference, that is strike price minus spot, that is reverse of spot minus strike price in the call option, if positive, that is strike price minus spot if positive, is called intrinsic value for put option buyer in the money situation. Now add the money. ATM option. An option is said to be at the money situation when the spot price of the underlying is equal to the strike price, reflecting there will be no cash flow occur. Intrinsic value of item is 0, that is spot minus strike price is 0. Any movement in spot price of the underlying from this stage would either make the option in the money or out of the money. That is, if the movement of the spot price from ATM, if it move upward, then for long buyer, long call, that is, he will be in the money position. And for put option, put buyer, he will be in the out of the money position. And if the market move downwards, then the call buyer will be in the out of the money position and put buyer will be in the money position, ITM position. Out of the money. An option is said to be out of the money OTM situation when the option buyer gets negative cash flow. In the case of call option buyer, he will be OTM situation when the spot price of the underlying is less than the strike price. Similarly, a put buy option would be out of the money if underlying price is higher than the strike price. The intrinsic value in option is either positive or 0, it cannot be negative. Now, strike, call option, put option is tabulated here. Strike in the money. That is, call in a call option in the money position will arise if strike price is less than spot price of the underlying asset. And in put option, strike price, if strike price is greater than spot price, then the item situation for put option. Intrinsic value will be spot price minus strike price, and put option strike price minus spot price. At the money, both are equal. Strike price is equal to spot price, so intrinsic value will be 0. Here in the put option, it will be 0. Out of the money situation arise if the strike price is greater than spot price in call option, and the intrinsic value will be 0. And in put option, strike price less than spot price, then out of the money situation arise and intrinsic value will be 0. The determinants of price option or premium. This is important. Spot price, if increase, the price of the call option, that is premium, will increase, and price of the put option will decrease. Because if spot price increase, then there is a possibility that the long call or call buyer will be in the item situation or position where the cash flow is positive. So the price of the call option or premium will increase. And if the spot rate increase, then for the put option, put buyer will be in the OTM situation, that is no cash flow. So the price of the put option will decrease. And now come, if strike price increase, the price of call option will decrease. If the strike price increase means the call buyer will be in the OTM situation, and strike price increase in the case of put option, you will be in the item position. So price of the put option will increase and price of the call option will decrease. Interest rate between base currency and quote currency. The price of the call option will increase and price of the put option will decrease. That is, interest rate between base currency and quote currency increase. If the interest rate between base currency and quote currency increase, that depends on the appreciation of the base currency. Appreciation of the base currency means the price of the call option will increase and price of the put option will decrease. Volatility. If increase, volatility means it is the movement of the underlying price up, on and down, fluctuating quickly and steeply, or fluctuating not as drastically. If it is drastically fluctuate, then volatility is high volatility, and if volatility increase, the price of call option will increase and price of put option will increase. Both will increase. And if it is decrease, then price of the call option will decrease and price of the put option will decrease. Next come time to expiration. The time to expiration is the difference between the expiration date and the contract date. If it is 3 months, then the premium will be higher for the option holder than that of the 1 month, because the effect of volatility is more in long period than in short period. So time to expiration if increase, the price of the call option will increase and price of the put option will increase, except of deep in the money position. Deep in the money position means when the strike price is significantly below the spot price. That is, spot price is significantly high. In the case of long call and in the case of long put, the strike price is significantly above the market price or spot price, or the spot price is significantly below the strike price. This is the situation which is called deep in the money. And in this situation, the option trader enjoys some benefit. Here, in time to expiration, they enjoy some cost reduction. So that's why it is written that that price of the call option will increase and price of the put option increase, except for deep in the money position. They are not increased so much. The determinants of option price or premium. It is tabulated here. If spot price increase, then the price of the call option will increase and price of the put option will decrease. If the strike price increase, then price of the call option decrease and price of the put option increase. Interest rate if increase, price of the call option increase and price of the put option decrease. Volatility if increase, price of the call option increase and price of the put option increase. Time to expiration if increase, then the price of call option increase and price of put option increase. Both increase except in the case of deep in the money, which is explained earlier. If the spot rate increase, then the call buyer will be in the money and will get positive cash flow. Hence, the price of the call option will increase. In put buyer, when the spot rate increase, the moneyness of option will fade out, so the option value will decrease. If the strike price is higher than spot rate, for this, price of the call option will decrease and that of put option will increase. Now come volatility. It is the magnitude of movement in the underlying price up and down, that is rising and falling drastically or not so drastically. If it is drastically, it is called higher volatility, and if it is not so drastically, it is called lower volatility. It is a key variable in option pricing model. It affects both call and put option in the same way. Higher the volatility of the underlying asset, higher the premium, because there is a greater possibility that option will end up in the money expiration. A lower volatility means that a security's value does not fluctuate dramatically and tends to be more stable. High volatility means higher premium both for call and put option. Lower volatility is lower premium both for call and put option. Volatility is a measure of how drastically a market price changes. A market liquidity has big impact on how volatile the market price are. Lower liquidity usually results in a more volatile market and causes prices to change drastically. Higher liquidity usually creates a less volatile market where prices do not fluctuate drastically. Volatility often refers to the amount of uncertainty or risk related to the size of changes in securities value. A higher volatility means that the securities prices are moving both up and down quickly and steeply. A lower volatility means that a securities price does not fluctuate dramatically and tends to be more steady. Now come currency volatility, which is characterized by frequent and rapid changes of exchange rates in foreign exchange market. A currency might be described as having high volatility or low volatility depending upon how far its value deviates from the average. Volatility is a measure of standard deviation. Major currency pairs which I have already discussed: major currency, cross currency pairs and exotic currency pairs. Here you see that major currency pairs tend to be more stable than emerging market currency pairs. Major currency pairs means in each currency pair there USD exists. The more liquid currency pairs tend to have less volatile and less liquid currency pair have more volatile. The crosses pairs do not have the USD and exotic pairs that include a non-major currency also tend to be more volatile than pairs of major currency. Factor affecting the volatility of currency pair. Economic or market related events such as change in interest rates of a country or commodity prices fluctuation often are the source of foreign exchange volatility. For example, a pair of currency, one from commodity based economy and the other service based economy, will tend to be more volatile since the inherent differences in each country's economy drivers. The interest rate level differences will cause a currency pairs more volatile than the currency pairs from economies more or less stable interest rates. There are two types of volatility. One is historical volatility and other is implied volatility. Now come historical volatility. Historical volatility HV gauges the fluctuation of underlying asset by measuring price changes over predetermined period of time. Historical volatility is the standard deviation which is calculated from historical prices of the underlying assets. It shows how volatile the security has been in the past and serves as a baseline for the traders to ascertain the past trading ranges of underlying securities and indexes to calculate the price changes. Historical volatility is an indicator to the extent to which a price may diverge from its average in a given period of time. It does not indicate the price direction but rather how unstable the price is. The historical volatility are generally calculated based on the changes from one closing price to the next. The computation of historical volatility is shown in table 1. You see, in table 1, the date is given in the second column and closing price of X Limited is given in the third column. And daily ln means natural log return, and this is computed using the Excel sheet, and the formula is equal to ln 2 by 100 into 100. That is, daily ln return is today's closing price by yesterday's closing price into 100. Here today's closing price, that is 3,850 divided by 3,800 into 100. Using it in the Excel sheet, ln is equal to ln 2 by 1 into 100. You will get this figure 1.31%. And next minus 3.97% you get, that is 3,850 divided by 3,700. And in this way all the figure you can calculate, and you see the ranges between the price changes. That is, lowest is minus 4.03% and highest is 4.17%. More deviation, more volatile. And volatility, that is calculated as standard deviation, which we apply the formula in Excel is equal to STDEV 2:15, and we derive volatility is 2.81%. This is from the Excel sheet. This is Excel sheet, and you see the figure is given. You can compute in your Excel sheet. It is calculated in Excel sheet where closing price of equity share for a period of 15 days is tabulated in column 3, and applying the formula L is equal to ln yesterday's price by today's price into 100 in the next column, that is fourth column, daily ln return of 14 days is computed. ln is natural log. Volatility is standard deviation. It is ascertained by applying the formula STVEV 2:15 in the last row of daily ln return column. Today I stop the class here. Next day I will continue this, that is, after the historical volatility, it will implied volatility and so on. Next day I will start with this historical volatility, then go to the implied volatility. Thank you.